Are you one of the many busy professionals working in offices day in and day out? Do you wonder how some people grow their wealth fast, retire early, and play on workdays? Well, you're in luck, because Ginny Bowling hosts this show, Pivot to Prosperity, where she interviews people that can do just that, play on workdays. Many guests have become financially free. She also interviews people that are on their journey and people that are in support roles, like attorneys, contractors, brokers, and others. Commercial real estate is the common element. She is on a mission to be sure busy professionals know they can own substantial commercial properties too, like apartments, self-storage facilities, and others, and not have to do the work managing them. Passive investing is the key. Syndications are the typical method. Tax write-offs are some of the biggest rewards. Ginny and partners find the deals, build a strong team and business plan, then offer the investment opportunities to passive investors. New episodes are released every Tuesday at 12, so watch for new releases. If you want to get involved, let us know. You need to get pre-qualified to hear about most deals. See the show notes for contact information.
Hey, Ginny Bowling here with Pivot to Prosperity, brought to you by Pivotal Real Estate Investments. And we have as our guest on the podcast today, Wayne Courreges. Wayne, thanks for coming on.
Yeah, thank you, Jenny, for having me on today.
Yes, well, I have been looking forward to having you for quite some time. We've done a webinar and we've known each other for, I guess, a few years now, right?
Yes,
So,
you were on my podcast when I was doing podcasting, so always fun to talk to you.
right. And you are located in Texas.
I am right smack in the middle of the Texas Triangle. Bryan College Station is where I hold my hat.
Well, and Texas has been a learning experience for me because, as you know, I used to be an appraiser, and then I found out Texas is a non-disclosure state.
Yes.
Makes people like me go crazy. And talking to my friend appraisers, I started calling. It was like, and in Texas, they say you got to be on the inside track, know?
But even then, it's, I wouldn't tell anybody what I paid for a property. Like we take it out of the deed, like all that. Like there's no, taxes are so, Texas gets their real estate or their income, through real estate taxes. Primarily because there's no income state tax right here. So real estate is the big money generator for Texas.
And another strange thing about Texas, I think, and I don't know if it's just certain counties, but isn't it really common to appeal your taxes?
If you're not appealing your taxes in Texas, you're
a good steward.
Yeah, it's an automatic. You should be doing that on your residential home. Like regardless if you're an actual investor or just a homeowner, every year you should be protesting your taxes.
Why do they want to ask for that problem? Holy moly, that's like a lot of work.
And actually we don't even accept because what happens is when you protest your taxes, your tax consultant will actually go and go to the appraisal board or the appraiser for the county. And, there could be a number that they agree to. And then even from there, we'll take it one step further, which is a mediation. And that's where you would go, you literally sit around a room, there may be 4 or 5 people, but then there's a mediator and you're really negotiating back and forth on values. And then and usually it's settled there because the next step after that is litigation. And so a lot of times there is, maybe a big tenant moved out or something drastic has changed the value of the asset and you may have to take it to litigation. I'm not a tax person, but there's the cost approach and then there's the income approach. And depending on what city you're in, could be a different valuation structure of that property. So yeah, Jenny, we protest, but not only protesting our taxes, we take it up to mediation. I've never taken anything to litigation because then a jury would be really deciding the future of your taxes. And I'm not going to think 12 people are on a jury, right? I'm not going to give it up to 12 people. We'll negotiate before.
12 is only in murder and eminent domain, I think. 6. I think it's 6.
Oh, 6. Okay. Well, there's, regardless, we'll settle outside the courts.
So, okay. I'm glad you clarified because I used to do tax appeals back in the 80s, and we did have the hearing officer and all that, but yeah, so maybe it's more handled administratively in a lot of cases than in Texas, is it?
So I've done the gamut where we, my tax consultant, myself would go and actually meet with the appraiser. And on the cost approach, like on the office side, they, when I worked for CBRE, we would protest the office buildings, and I'm going to say property A, it could be a valuation of 30 million, and down the road it could be a couple years older, and so if that valuation came in less, maybe there was deferred maintenance or something. Like we would argue like how bad our property is. Like the goal is to like our property sucks. Like it is an awful property. We have so much deferred maintenance. Our tenants are paying less than market. Blah 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 blah. So from that standpoint, you're trying to stack the properties of like, hey, property A is a nicer property, so they should be paying more in valuation than my property, right? And so you sort of stack it that way. And so a lot of times that's how it works, where you can value the properties, get on board, like, hey, I feel comfortable paying my taxes here because I know a nicer building is paying another tax. When you look at it from an income standpoint, that sort of goes out the window. It's all based on your rent roll. And so, cities like Houston, it is heavily especially on the multifamily side, income. So now one of the things that we also do, and, this is a different time than it was a few years ago. A few years ago, taxes would be a lot less than what you're purchasing. The valuation that the city has on file would be less than what you're buying the property for because the city hadn't caught up to the valuation increases spiking. What now is happening, valuations are high, say $12 million for an asset, but the property is only worth $10 million. And so I bought two properties like that where the valuation of what I've actually been buying is less than what's on the appraiser. And so from that standpoint, it's the easiest protest. Yeah. You just take the sale agreement, right, to them. So that's been very, very nice for us, and realizing those instant expense reductions, right?
Yeah.
Helps our that's cash flow and valuation of our property. So, but yeah, but if that appraisal meeting, like the initial one, doesn't get you to where you want to be, then you would take it to mediation. And that mediation is, a lot of times with the judge, or, a city appointee where they would come in, a neutral party between the city and you. And, there's literally passing of papers of, this is my valuation. No, they leave, like it could be an all day back and forth. And then if that doesn't work, then you do take it to litigation and you do have a jury that would make the ultimate decision.
So the big question is, after you go through all that 1 year, do you have to do it again the next year, or does
you absolutely do it every single year? Yeah.
Oh my gosh, what a waste of time.
Yep, you do it. But here's the thing: the tax consultants, they get their money by the savings that they can get you for the property. So you're not paying an attorney or a tax consultant anything unless they can find you savings. So there's incentives, and I'm sure in the back some good old boy club type talks of like how they negotiate down prices, but it's something you absolutely do. And
Wow.
So it's not when I look at it from a real estate tax, it's not really a separate line item from an underwriting standpoint, because it's only paid if your taxes have some savings. So usually there's that buffer in your property tax number to pay your consultant because they found you savings, if that makes sense. You're not having to pay them if they don't find the savings.
So do you underwrite at current taxes?
Yeah, it's a great question. So currently I underwrite it for 95% of the purchase price that I'm purchasing at. Typically we can see 90 to 85%, but year one in today's market, it's really based on my purchase price, 100% of purchase price, because usually it's already less than what the valuation is. So it's 100% at the current tax rate year one. And then year two, I usually bump it 10 to 15% each year just to give it a little bit. I don't tie it straight to my other expense pool, which may be 2 to 3% increases. It's going to be a little bit more similar to insurance. There's going to be larger increases on that as well.
Well, and so we jumped right into the thick of it, but that's because you're so knowledgeable. Because talk a little about I didn't even read your bio.
No, you can. I mean, we can be casual here. So, a little bit about myself is I joined. I went in the Marine Corps 2003 to 2007. I bought my first single family home in 29 Palms when I was in the Marine Corps there, and then I joined CBRE in June of 2007. So I had just got out of the Marine Corps, joined CBRE literally like 2 weeks after getting out, and I was with them for a total of 16 years, heavily on their property management side with some asset management involved there. So understanding the operations and the life cycle of a property is just what I have always known and what I've enjoyed. And so in 2019, I was like, I'm making these institutional groups and people really wealthy and doing a good job. I was like, I feel like I could be doing that myself. And so multifamily was something that wasn't competing with the day job because CBRE focused more office, retail, and industrial. So I got into multifamily just because it didn't compete with my day job, allowing me to do these. And then over, really quickly, honestly, over that first 6 months, and I got a mentor, really just got all in on multifamily. But just really got really bullish, especially because I saw a lot of the ups and downs of office and retail and even industrial. And so I liked multifamily. And so I started that in 2019, CREI Partners. And then last year, June of 2023, I gave my 3 week notice to CBRE after 16 years and went all in on our investments. We had grown the company to a point where it was hard to do both and do both well. And so I just felt guilty going into work every day because all I could think about was our investments. And that wasn't good for anybody on the W-2 side. So I gave my notice and here we are about a year and a half later. And I just hired 2 full-time employees and excited for the future. So that was high level in a nutshell, so you didn't have to read my bio.
Well, that's terrific. And that's a fantastic background working, with CBRE, of course, and doing offices in particular. And I could get into talking offices and because I like urban renewal and we know they need to go through some renewal, right? But
Absolutely.
we're not going to do that because I want to talk about the projects you're working on.
Sure.
So first, let's talk about you have an unusual industrial property approach. Will you talk about that for a minute?
Yeah. So for Lex 20 or 20 by 50 storage.
Yep.
Yeah. So our family enjoys going camping and I really should say glamping because in Texas it's pretty hot. So we have a travel trailer. We like to go camping. And when you get into like those parking spots and you're like next to the $1 million RV or $500,800, like it just makes you like, wow, those are great. How do they, one, own something like that? And then two, where do they store it? So I had always been thinking about these type things. And then one of our mutual friends, Stuart Heath, he was letting me know that he was buying a 20 by 50 storage facility in Huntsville, Alabama. So we partnered with him and brought our investor capital to it. And what these places are, they're all 20 by 50 in size. They all have 14-foot by 14-foot roll-up doors and then a walk-in door. They all have LED lighting, 30 amp or 50 amp power, 110 volt. And when I went to see Stuart and visit the property, this is after we bought it, we were changing out leases, we were changing out locks. And I just had realized like meeting these tenants that were there, because I was trying to figure out like, why do y'all need this space? I mean, the gamut is just crazy of like, you got your hoarders, you got your personal like moves, right? But then what really got exciting were the businesses. There were so many businesses that needed this large space for their inventory. And this would go for HVAC, electrical, mechanical, generators, disaster recovery companies. There was a company that like goes and cleans trash cans in the HOA neighborhoods. So he has this trailer, he goes in and, pressure washes. I mean, it was just, the list goes on with businesses. And then they have these high-end RVs, these places that, when I was camping, like, where are they storing it? Well, they're storing it. I mean, these are 45-foot long RVs and 13 feet, 9 inches high, tall. And so there's not a lot of places that have this fully enclosed feel to it. So I got super excited, Ginny. I was like, I need to develop these because they're there's not a lot of these around. So I came back home, Bryan College Station, bought about, I'm gonna say a little less than 5 acres. And we bought that land in June. I got the loan and the investor capital by October. And we finished developing and opening July 1st. And we're about 35% leased as of today. And so when you look at like your standard lease up for self-storage, it could take 3 to 4 years to get into the high occupancy. We fully expect to be 100% leased in less than 12 months. And oh, by the way, Ginny, like once I hit 40 units, it's all cash flow. So if there's 72 units, there'll be 32 units at $750 a month that just, cash flowing. And so that's what we experienced at the Huntsville location. That's what we're doing here. Once we have the second case study, we'll continue growing. So that's the 20 by 50 storage space.
Right. Yeah.
And it doesn't take, I mean, most people don't need a 20 by 50. It's that 1%. And even of that 1%, there's probably there's like 10% of the 1% that need something like this. But once you find those people, they stay in the unit. They don't leave. So
That's awesome. Yeah, that is. Do you divide up any of them to split them in half or?
no, they're all 20 by 50. So you either need the space or you don't. A tour or two this past weekend, one was a company that does like car wraps. They're and it's part-time, so they're just going to wrap. They go to the university here, so it's a couple students. And so, they'll have that. And then the other group, it was a husband and wife, and they have storage. Even they said like, hey, it's probably a little too much for us, but we can grow into it. Can you imagine 1,000 square feet of storage? It's too small for us, but we'll probably grow into it. It's like, I've got one customer, they had multiple units at a local storage facility. And so they consolidate everything to one unit. I've got one customer who has 3 units. He's got his motorhome. He's got his 3 or 4 high-end cars that he rotates throughout the week. And then he's got his over whatever extra stuff that he has. And so just got cabinet companies, interior design. They just expanded into another unit because they have all their inventory. So when they go and put stuff in homes, there's a word for it. I don't know, when they go put in furniture that doesn't belong to the actual
to staging.
Staging, yes, thank you. So, but they keep that in our storage, and I'm like, it just,
Yeah.
Yeah. And those people, once they're in, they're not leaving. It's not like you have the churn. So I've been really focused on that, and then of course, multifamily, staying true to multifamily when a lot of people are not staying as true to multifamily as they were just a couple years ago.
Yeah. Yeah. We'll get back to that about the multifamily. So tell us about your development deal.
Yeah. So I told you we developed a Lux 20 by 50 storage last year. And so that got me a taste of development. When I worked for CBRE, there were other developments that I was part of. I wasn't the developer per se, but I was part of a lot of the construction meetings. And I've always had the interest of developing, but it didn't really hit me until I guess June, July this year that I'm also a developer. And I say that because it's easier to develop a property that already is zoned, X, which was my 20 by 50. Like it was already zoned for like warehouse. Like it was, submitted plans to the city. It was pretty easy approval. But most recently, we took a retail zoned property that we had purchased right off Highway 6 here in Bryan. And we worked with the residents and the city council to rezone that into a planned development multifamily. So there'll be 150 units there. It took 2 city council meetings, a lot of meetings on couches for the residents. And so I really enjoyed that aspect because, you want to give a good product to the community. You want to be part of the community because I live here and, I'm going to see these people at Kroger or the theater, which is right next to it and such. But a lot of rumors can start spinning out of control when a developer isn't as engaged with the messaging. And so I realized I was a developer once I was on the news and they were city council. It was a city council meeting and I was the evil developer, even saying I was based out of Houston and why don't I put this land, property on my land? and all this stuff. It was just like, oh my goodness. But anyway, it did get passed. And so we were able to have this project. So that's a project. And then we are buying the land. We already bought the land next to it. And then we're buying the other piece of land. So we'll have a total of 12 acres. The multifamily will be 6 acres, and then we'll have another 6. And we're launching our broker request for proposals to start engaging that broker for retail representation. And then this morning I had a call with a consultant who does hotel feasibility studies, and that will be an expense that's not paid by equity investors. A lot of the risk and the expenses happen before we get equity from investors. But I think that's going to be a well worth, 5-digit expense to understand, like, hey, this is could a hotel go there? And if so, what type of hotel? Is it a full service, type hotel, or is it a 100-unit, Comfort Inn? Who knows? So we're going to be going down that road as well. So I'm excited for that. That will be launching. The multifamily for sure will be, the equity raise will be early 2025. And then we should have our loan approval by June. And then, hopefully we'll kick off that project. In the meantime, we're also looking for, stabilized or value add multifamily as well. So I try to develop, Ginny, locally. This whole area, Bryan College Station, is just booming. You've got the University of Texas A&M, but you've got a lot of jobs coming in supporting RELIS, which is a research campus. You've got a semiconductor plant that's going to be building out in this area. And I just want to be local to what I'm developing, being part of the community, but also like being able to manage and get to see the property and then go home at night, right? So we buy properties outside Bryan College Station, but we want to develop inside Bryan College Station.
I couldn't agree more. I think I told you I was an appraiser in the 80s, so that was the savings and loan crisis. And I was appraising lots of projects that went belly up, not necessarily because they were bad projects. It was the banks took over, and people, especially being remote, didn't know what was going on, and the banks didn't start the faucet back fast enough, and this and that. But so I got PTSD on it. I would only do development if I knew that there was a team member that was really on it right there every day.
Yes. Right there every day. And then working like for the Lux 20x50 storage. And for that, I was able to GC it myself. I mean, we had several trades, but it wasn't overly complicated. But when you're dealing with homes, apartments, we hire a general contractor who's experienced and has tons of experience and on-site supervision, for that. And so it's fun. You're sort of the quarterback. You're not good at really anything in a way, Ginny. That sounds horrible because I never want to be like the smartest guy in the room, but I surround myself like with really exceptional people who are like good at their architectural or their civil engineering or structural or, their construct or whatever it is. And you just build that team. So it's fun because you're just surrounded. And I sit on these construction calls every week and they do all the talking. And of course they ask for owner opinion and all that stuff. But it's like, once you surround yourself with a team who's done it, it's fun to watch. And then if you can lower the risk by like doing those feasibility studies and understand, like we met with the city last week of like, what do they want from that site? Have they spoken to anybody that wants to come to Bryan, but they're looking for land, et cetera. So you just have those conversations with as many people to see like, hey, what could go at this location? And then once you figure it out, you just go over hurdle by hurdle and you get through it and have fun with it.
Yeah, I get it. I do. I like that challenge, like we were saying before we got on the recording. But yeah, and so I'm going to be tracking that, and we're going to stay in touch on that. And then so also, before we talk about multifamily, I want to share that you have written a book, right?
I have written a book. I'm excited about it. It's going to be coming out in the next few months. And so my goal is by the year end is to have it go live. It's called Courage to Invest.
That's 2 months to the year end, you know.
I know, but that's why I'm giving myself maybe another month into January so I don't like promise myself something that doesn't happen. But honestly, it's already pretty much written. I have put many hours into it, and gotten some help through some writers. Like, I'm no writer, but there's a good editing team, and I put in a lot of my stories about passive. So it really focused on educating passive investors. There's a lot of books about actively managing real estate or developments, but there's not a lot of books that just focus on passive investing.
Right.
And so I really, through personal experience and try to put a lot of stories of, from my experience, the wins and, the not so good of property investing, because there's risk, and anybody that was in 21, 22 has a property that isn't doing well. So like, we talk about that, and we talk about, what was the process, and even, my black eye of like doing a capital call, it stuff isn't, it's not all roses, but it's like, hey, if you've got a sponsor who's like in not putting his head or her head under a pillow when things get tough, they're communicating, they're working through solutions, they're able to, modify loans or put in more money, that's what investors want. They want someone to truly be the jockey of the asset, not only in the good times, but the bad times. So I talk a lot about the good, because there's a lot of good. I'm grateful, knock on wood, like all my properties are doing well. I've got one that, we're modifying the loan. And if you would have asked me 6 months ago what would have happened, I would have known. Like, now I know, like, hey, at least we have, a good runway to continue pushing the asset. So I'm super excited about that. But hopefully, given my experience and just being real, to help investors become educated on understanding the risk, but also like, how do you look at a deal, and how do you know if it's a good one to invest in or not? So,
Right. And say the name of the book again.
so it's called Courage to Invest. So it's a spinoff of my last name, Courreges, but Courage to Invest is the name.
Yeah, I love that. Love that. All right. So, and multifamily is the thing that brought us together initially. And so let's touch on that here too, and see what you're into.
Yeah, so I'm so grateful that so many people are running away from multifamily. It amazes me how, like, we talked about it a few years ago, maybe not you and I, but like I would just always talk about like herd mentality, and herd mentality of like people, even like in corporate world, everybody doing their 401k or maybe doing a Roth, or, like, this is where most Americans are, making their retirement wealth, and they're growing their wealth is through contributing up to $23,000 a year to their 401k, either pre-tax or after tax, right? That's where a majority of people, are saving for retirement, or they have their money in their house. uh, and so not a lot of people were, really knowledgeable about investing in Main Street or going into syndications and stuff. So, there were times where like you didn't really have to have much of a heartbeat at all. Like, you could just have gone away and your management company would have performed sort of adequately, and you could still made money on your returns. And so a lot of people got hurt. And there were so many times where I would have passed on a deal, and a broker would say, at one broker in particular was like, hey, the deals that you're passing up now, you're going to regret later. It's sort of like that constant. And I go back to that one property that was a struggle. I don't have regrets buying it. I felt like we did our due diligence and stuff on that, but there were so many properties I didn't buy. And so a lot of people bought and bridge debt. They didn't have rate, they didn't spend money for the rate cap. And so a lot of them are struggling. And so now you see a lot of these people going into car washes. I mean, there was a time where like ATMs, there was a time with crypto. Well, crypto, if you invested in crypto, you lost money. If you invested in those ATMs, it was like a big Ponzi scheme. Like, it was just, and now I see a lot of people investing like in car washes. And I don't know about you, like where I live, car washes are going up all over the place. It just seems like the thing, the investment, the shiny investment. And so I've doubled down on multifamily. I know that there's a lot of investment choices, and I know that multifamily hasn't been as sexy with returns over the last few years. But think about all the people that would have made money during like 08, 09 if you were buying in times when people were running. And so that's been a big thing of mine. I mean, we're buying deals, 20, 30,000 a door less than what they were just a few years ago. And we're buying in strong markets. And so if the numbers work today, in my opinion, they're going to work a few years from now. I've shifted Ginny a little bit or heavily to cash flowing deals, and it doesn't have to cash flow 6-7% year one, but 2 to 3%, at least there's cash flow. So my risk tolerance has changed a bit. But yeah, I love multifamily. Everybody needs a place to live. They're not making new housing. These housing starts for new developments is less and less. And so there's going to be a supply issue in a few years. And, our investors and our company, I feel like we're going to be really big beneficiaries of it, when this cycle.
I agree, because it's very unlikely interest rates are going to go up, and it's very likely they're going to go down. So if you can cash flow now and buy now, then yeah, instead of buying when there was all that FOMO and the prices were going up, it's way better to be buying from here. And yeah.
Like last year we bought a deal. It was, and look, for those listening, if you're an active investor, even a passive investor, a deal can be found in any given market, right? And so like in 23, we bought, and we only do 1 or 2 deals a year. I only bought 1 multifamily this year. And, but I'll talk about the 23 one. It was a property in the Galleria, and we did seller financing. It was 6% fixed rate. And that has cash flowed for our investors day one. And, we've pushed income, we've reduced expenses. So NOI, I mean, we're in really good shape there. And so, but that was a seller financing 6% fixed rate for 5 years. And the deal we just closed on that, took me most of the year to close on just because it was a a loan assumption through Fannie Mae. That was 128 units in Houston. That loan was a 3.82% fixed rate debt, had another 5 years left. Again, another cash flowing deal. So new debt may not work, but finding and being able to, position yourself in those opportunities of seller financing or loan assumptions is massive for, getting deals done in this type of market.
And was that a HUD loan?
That was a Fannie Mae loan.
Fannie Mae, okay.
Fannie Mae, yep. So, and shout out JLL, helped us navigate that process. It is not easy to get any type of loan assumption right now, but if you got that team back, what I was saying earlier, you surround yourself with great team members, we get through it. But yeah, that deal closed in late August 2024.
Well, I have to talk to you more after we're done, because this deal I've mentioned to you, there's an assumption that I haven't gone through the process. I've worked with banks a lot, of course, through eminent domain. We used to have to get assets released, carve outs of all kinds, sometimes even really weird ones,
Luckily, it was they didn't ask for anything more. I mean, it was a lot of going back and forth, proving things. I mean, pretty much if you put anything on your document with when it comes regards to your, real estate owned or your financial statement, I mean, they just really dug into it. And then, it was a lot of, I would say, detail on their end. They did a great job of just making sure we were legit and that we could, operate. No, Fannie and Freddie, they don't want to, why would they want to give a property that's already doing well with sponsor A? Why would they want to assume that risk to sponsor B? And so I had to prove with our team that we were just as good of an operator, if not stronger than the other. So that
makes sense. Yeah.
That's the hardest part, right? Because they're not incentivized by you taking over. There's no incentive for them. So anyway, it's that was a process. It was my first one, but it was great to get that across the finish line.
Who at Jones Lang will help? Was it just personal contacts that you have, or?
Yeah, so JLL was the originator of the loan for Fannie Mae, so they acted, so a lot of times if it's a loan assumption, whoever that originated the loan would be the one. And so if that loan was originated by broker A at JLL, then broker A at JLL would be probably the one assisting you through that process.
Interesting. Yep. Okay. Well, and I forgot to warn you, at the end of these interviews, what I always do is I ask if there's a pivotal person or event that brought you to where you are today and or pushing you forward to something in particular. Yeah. Are you able to talk about that off the top of your head?
Yeah, I mean, there was a person in high school that I looked up to a lot that was a real estate developer out, in Austin. And one of the things he, preached to me at an early age was like, buy and develop land outside the city. It's easier to close on deals, but also cheaper. And eventually the cities grow out. I mean, imagine any city that you're at, it grows out. And so that was a pretty, he got me the bug for real estate investing. And so, that really started my real estate, because I mean, my parents we didn't talk real estate. But it was through him and seeing what he was able to provide for his family that got me into it. And then I've had a lot of mentors and people that I've been very grateful for. When I worked for CBRE, I left the company on good terms. I appreciated everything they did for me and our family. And, from an operations standpoint, I wouldn't, I tell our new employee, Noah, that it's easy to find and buy a deal. That it's not, nothing's easy, but you can go out and some friends, you can buy a property. You may not buy the biggest property, but you can go buy a property. But it's like, how do you operate it? And most people don't talk about operations. They don't talk about asset management. And so I'm just grateful for that foundation of asset management, because at the end of the day, like, that's what keeps investors coming back. That's how you battle the storms when things aren't attractive. And it's not fun for a lot of people. Like, it's fun for me, but so many people are leaving the real estate industry because they're realizing, like, hey, this is not an easy business, right? You actually have to operate a deal actively, not just have your management company send you a report once a month.
Yeah, for sure. That's a big deal. And it's not the easiest, especially in multifamily, because people are moving constantly. Drama happens. Yep. Accidents, all kinds of things happen, but
you saw the stuff. But I feel like, for those listeners who are looking to get into passively real estate investing, it's sort of see where the sponsor was a few years ago, where they are now, or the syndicate. Because again, I just see a lot of these people, they go where the wind's going. And it's like, we've doubled down and become even more of an expert in multifamily, even though like there's shinier and some more attractive things out there. But I'm like, that is a current moment. But like, if you look at historically at what multifamily has done, I mean, it has historically been a top asset class within commercial real estate. The depreciation, for example, my storage deal, which a lot of investors want that tax depreciation, it gives a lot less depreciation than, say, a multifamily, because it's steel and concrete at my storage.
Most storage items, right?
Yeah, you think about, so you look from a depreciation standpoint, multifamily wins the day. You got forced depreciation through reducing expenses, increase in value. But then, like, for my loan assumption deal, like, those residents are paying the mortgage down, so it's like it's just the best of all worlds. I love it. And yeah, it's tough. And, but you look at it from a long-term standpoint, and our investors will do and are doing really well with it. So I'm going to continue buying multifamily.
I'm with you. I'm always looking for that too. Let me back you up though. You're a pivotal person. Are you still in touch with them?
I am not. I have not reached out to them in a long time, but he's been on my mind. I may reach back out to him.
I was going to say, I do this special series of local legends and pivotal people. Mm-hmm. And if you want to nominate him, he'll get a special mention in this show anyway, and in the show notes and all. But if he wants to even come on the show, then he gets a pin saying pivotal person.
Nice.
And, gets on the show. So.
All right, cool. Well, that's good to know. Yeah, I don't know if he would, he's a pretty private person, so I'll leave it at that. But he made such a huge impact early on, and just somebody that I think about often, and like, hey, I should definitely reach out. So I do plan on doing that, at some point in the near future too.
Well, especially with the development coming up too, might be opportune.
Absolutely.
Yeah.
Yes.
Very good. Well, so we got to wind it up. Why don't you tell people how they can reach you? And remember, some people on Spotify or iTunes only have audio, so spell.
Yeah. Well, I like to give value. So I have an ebook on multifamily investing. If you're learning about passively investing or want to know more about multifamily in particular, check out CREIPartners.com/ebook. There you can put your info and you can get the ebook. it's I think, a really well written document, but at least it gets you learning about multifamily passive investments and then a little bit more about our company at CREI Partners. But so again, that's CREIpartners.com/ebook.
All right. And to reach you?
Go to the CREIpartners.com website. But if anybody also wants to email me directly, Wayne@CREIpartners.com, will get directly to me as well.
All right. Very good. Well, thank you, Wayne. We'll have to keep doing these periodically to keep up with each other.
I would love that. Thank you, Jenny, for having me on today.
Thank you.